Ryan Kulp is one of the founders of FOMO. He also runs an investment/equity firm for investing in new startups. He's bought and sold multiple businesses, including selling Simple Apps to me and Robert. I bought Simple Apps for $2,500 and so far have made at least 4x on that purchase. So I really like Ryan, and I had him on the podcast a few months ago to go in depth on his investment strategy, why he sold Simple Apps, how he thinks about businesses, and thinks about new projects. If anything, Ryan is a launcher. He tries to launch, I think, 2 or 3 new projects a month, it seems like. Plus he's doing music and has an art side to him. And in this video, I want to share with you what we went over. So enjoy my conversation with Ryan Kulp. Ryan, welcome to the show.
Thanks, Alex, for having me.
I'd love to learn a little bit more about Fork. Can you give me like a high-level overview of what you guys do?
Sure thing. So I've never really been the type of entrepreneur or just human to do only one thing at a time. And so even though FOMO's been going really well and we've been working on it a couple of years now, I still wanted to kind of venture out and see what else I could do to either appease my own personal interests, maybe to make a little extra money, whatever the case may be. So over the last couple of years, I did a lot of freelancing and I started a lot of different side projects. Some of them made money, some of them didn't. And after I kept going through this process of spending a couple months, 3 months working on the MVP, only to then figure out, does the market care? Does anybody want to pay for it? I decided to try to buy apps that had already kind of gone through that process. And not only the development process, but had already gone through the early product market fit process. And when I started looking around, I found that there's a lot of products that, they're built-in technologies I understand, they serve a market that I can grow to understand, but they're just not big enough to raise venture funding, or they don't have the vision of being a venture fundable company. They are maybe run by digital nomads, they're run by solopreneurs, they're run by marketers who hired a dev shop to build the app, and now they're sort of just growing with what they've got. And there's a lot of these apps out there. And so what I started doing is acquiring them. This could be through all cash deals. This could be through seller side financing over time. And as we got more and more creative with terms, and as we got better with sourcing these companies and negotiating with these companies, and then of course, after the acquisition happens, growing these companies, we decided to effectively put a bow on it. And so that's what Fork Equity is. It's kind of a formalized process and version of what I've already been doing for the last year or so, which is buying small apps, growing them, and then hopefully one day reselling them.
And it sounds like you're scaling up that process of buying FOMO that we talked about last time.
That's right. We bought FOMO was effectively the first acquisition, or my personal first acquisition. There was a Shopify app called Notify that we acquired, and we rebuilt it from scratch. We rebranded it to FOMO, and now here we are, 4.5, 5x bigger than it was when we bought it just under 2 years ago. And so over the last 6 months or 8 months, we've done another, I think, 5 deals. And these are apps, that range anywhere from on Shopify only to web apps to SaaS tools for florists. This is our most recent one, to even a blog and resource, and even a competitor app that we shut down right away. So we're trying to kind of stay in one realm in the sense, B2B SaaS, but on the other hand, we're pretty open to things that solve real problems and that people are willing to pay for.
So 2 questions. I guess we'll do them one at a time. What's the average acquisition, Ben?
The average acquisition, it's funny because I was reading or reminding myself this morning about fat-tailed distributions versus normal distribution curves, right? And so there's the difference between average and typical, or average and normal. So average, I suppose, would be $500,000, and typical, or at least the most recent deals we're looking at, are even under $100,000. And these are products where maybe the payback period isn't worth it for the founder because it makes so little money on a month-to-month basis that they not only would have to work on it for a couple more years to get the amount of cash that we can pay them, but they'd also have to potentially have another full-time job. And so what we found is this sweet spot where, you think of selling a SaaS tool. If we sold FOMO, let's say we would want a 5x plus multiple on our annual revenue. A, because we're SaaS, B, because our technology, C, because we have pretty good margins, right? But we would want a 5x multiple because we're very happy with what we're doing. Maybe we'd want a greater than 5x multiple. But if you're working on something that makes $1,000 a month, to support yourself, you probably need at least triple that, even in suburban neighborhood of a less expensive area in the United States. You need triple that to survive. So that payback period, we don't have to necessarily pay a 3 or 4 or 5 year payback period. We could give someone an 18-month payback period, right? So their app makes $20,000 a year, 18 months is a year and a half, we give them $30,000. And that's a huge win for them because now they don't have to feel like they have 2 jobs for the next year and a half. They can just have one. And it's a bigger impact.
And
yeah.
Well, that's also a not too big of an impact for you guys as well, because 30,000 over a year and a half, or even over a year, is barely any money per month compared to having to find that cash and drop it up front.
Yeah, that's exactly right. I mean, now that we have a team and we kind of understand approximately, in approximate terms, okay, if we want to build an MVP and I wanted to put my existing team or teams on it, a designer, a developer or 2, and a marketer to get some initial traction, let's say that's 20, 30 grand, maybe 40 grand, just to kind of drop in the bucket to just have something. And I have to wait a couple months for it. Whereas in the acquisition space, you kind of turn the key, they give you the passwords, and you're off and running. And not to mention that when you have enough capital, and I mean in a personal sense, when your needs are taken care of, right? When you're at Maslow's hierarchy and you're going out to eat and you're paying your rent and you're doing your basic things that you want to do, even if we bought these types of assets, so an app that makes 20 grand a year, we buy it for 30, 18-month payback period. Even if we bought it and didn't do anything with it, if we just waited out until month 19 and then we're making a grand a month, that's going to far outperform any type of traditional investment index fund stocks that we could do. And we don't even have to, who says we even have to make improvements? So if we could just afford to wait 18 months, it's already a win. Not to mention that our intention and what we've been doing is getting in there and actually improving the apps and growing them. So then we shorten that payback period even further. So, I think our ideal is like an 18-month acquisition cost to us, and then we pay it back in, let's say, 10 months based on kind of scaling the growth and that kind of thing.
That was what was so interesting about the Simple Apps deal. So to fill you guys in, I bought a small company from Ryan. I don't know if you want me to discuss the price of it or not.
Hey, up to you.
Okay, so I bought this Shopify company that was making a little under $200 a month for $2,500. The exact same mindset that Ryan had. I figured, 6 to 8 months it's going to pay itself off, even if I do nothing to it. And I wanted to ask you quickly, why did you sell that app? Is it the time investment from customer support? The growth wasn't worth it? Like what was going through your head?
Sure. So we're always trying to value or revalue and kind of configure our time to money ratio, right? So every couple months we wake up and we're working on XYZ projects, especially people who are doing something a little more entrepreneurial where every month or 2 you have different things on your plate versus potentially some roles where you do similar things every day for a while. Every couple months I wake up and I say, what's kind of on my plate? What are the things I do at 2 a.m. versus 2 p.m.? What are the things I think about when I'm having fun versus things I think about when I'm, in the bathroom or the shower? And these are weird ways to look at it, but capturing a pulse of your energy and how you spend your focus to me has been really helpful in understanding. And what I'm doing today is what I'm doing today worth my while. And with Simple Apps, it was, as you know, collection of 3 pretty different apps. They're all small utilities for Shopify stores. And I think that one reason I wanted to focus on other things is that I couldn't bring myself to hopping in and making each of those apps 10 times, better. I could maybe make them bigger. I could get more users. And of course that causes more support, but I didn't have the energy to invest to make them better products. And when I look at the companies we buy on a somewhat now regular basis, every month or so we've closed a new deal. I look at those and I'm so excited to hop in and rip out the UI and redesign things and change pricing and build new features. I'm so thrilled to do that. And so when I'm juggling these different projects, I looked at Simple Apps and I said, okay, I can write it out, right? And then just get my time back for what I've spent building it. Or I can do these other deals where I already know day one I'm going to have the energy to get in and improve upon them. So yeah, it definitely wasn't too much about the money, right? And I think it's good that we both had the same mindset on the other side of the table of, there's a wait period. If you can afford the wait period, then it's a win no matter what. And if you want to put in extra juice to accelerate things, then that's even better.
And it's interesting that you highlight that because it's 2 different approaches to entrepreneurship. So you buy a business, you're excited about business, you immediately want to jump in there and start making changes. I'm kind of the opposite, where I used to really think like that, wanted to jump in. But with Simple Apps specifically, what I saw was, I can just let this sit for a while and let it stack up for a few months, let it return. But then what I found is I was talking to my co-founder from X27, Robert, he runs basically a Romanian development agency on the side. So they've got marketers, they've got support people that speak English. So what we found out was we can basically have his team take it over, not make money on it for the next like 6-7 months, and just basically try to grow it that way. So rather than going in and tweaking stuff, personally, now we've got a team on there.
Yeah, sure. And that's kind of what I'm realizing with Fork. We want to buy 10 companies this year. We've done, I guess, 1 or 2 so far. So we're sort of on track time-wise, but it's pretty aggressive to buy 10 companies. That's a company every 5 weeks, which means you're really getting people to say yes every couple weeks, maybe even every 10 days, because half the yeses will turn into nos by the end of the diligence process for whatever reason. And that means you have to be talking to, let's say, a dozen founders a week. So it's pretty aggressive to try to buy 10 companies in a year. But even beyond that front end reality, on the back end, let's say someone gave us 10 companies today. How do you manage 10 companies, right? Even, a marketing agency, and you're running a marketing agency. I used to run a marketing agency. At any given time, if we had 5 clients on retainer, that took 7 or 8 full-time people to make it happen. So how do we scale to 10 companies in 1 year with a centralized team that services them all? And so we're kind of doing something similar where the first quarter, potentially even the first 2 quarters, but our sort of current model to our investors is that the first quarter of operations for any deal, exactly whatever cash comes in is what we spend back on the product. So this flower platform we bought made around $1,500 a month, a little bit more. The first day, I think within the first hour of acquiring it, we hired a designer for $1,500 to redo the landing page and a few screens inside the app. So it was like month 1, gone, right? Month 1 capital gone. Month 2, which just began, I think a week ago. Yeah, a few days ago, because we bought the app January 11th. Month 2, I immediately sent a newsletter to say, welcome to the 2.0 of this product, which had the new interface implemented. And I said, hey, we're now selling annual plans. And within a few hours, boom, we made back $1,500, $1,700, $1,800 in annual purchases on $300 plans. So now we paid back last month's investment, and we're going to do closer to $3,000 this month in sales. And this month, we're going to try to invest that extra grand, let's say, into marketing experiments. So we hired an intern, and he's been doing things like chatbots, Reddit, ads, sponsorships, a little bit of stuff here and there, queuing up Twitter, Instagram, all the basic channels that you want to experiment with. And so we're going to kind of continue going that route. But I think by month 3 or worse, month 4, we'll be at a point where, let's say the net is $1,500 plus a month. And now we're back in that hold period on our way to earning the initial investment. And of course, hopefully earning it sooner than 18 months.
What I love about this, even more so than what you're doing, is this style is the easiest path into entrepreneurship, right? Imagine you had a full-time job, where you were able to stack up 30, 40 grand in savings. If you found the right deal, you bought the right deal, and if it's stacked monthly like that, you could acquire a business and not spend any money.
Yep, that's exactly right. Well, and not to mention that I think the types of decisions that are made in entrepreneurship, particularly tech entrepreneurship, that cause problems are the ones that first-time founders make when you're starting something from scratch. They're specific to that stage and that context, right? So if you're a first-time founder starting from scratch, that's when you decide on your company name. That's when you decide on the domain, the overall design aesthetic, the messaging, maybe your early pricing if you're going to have a forever free plan, the technology that you use, right? If you don't know how to code and someone says you should use ASP.NET or something like that, and then you build your MVP with that with a dev shop, then these become really big problems later on. And again, those are problems that a second-time founder doesn't have. And those are problems that whether you're first or second or fifth-time founder, you don't have if you get into the business through acquisition versus having an idea on a Saturday and hiring a dev shop Monday. And so I agree. It's a safer way almost to get involved because you already have something that works, that solves a problem, that people are paying for, that people depend on. That also means that you don't have to do customer development surveys blindly. You can actually ask real users. I remember when I was getting started in tech and entrepreneurship, or tech entrepreneurship, I should say, and I would try to theorize what customers wanted, try to theorize problems I could solve. And I would ask kind of veteran people in tech, how do I do this? And they always say the same thing. Ask your users, just ask your users. And I say, yeah, but I don't have any users, right? And this was like this repeating revolver of advice. Ask your users, and then you can. I just thought that's not good advice for first-time founders because you don't have any users. But if you acquire a company, you do. And look, you're gonna need a probably, if you don't code, hire a dev shop anyway, or if you do code, hire a marketer anyway. So it's sort of silly if you can get a decent multiple, on the deal, if the founder is motivated for the right reasons to walk away and to pass it on, or they've plateaued in some way, then it's a really big win-win, and you can kind of go back to dreaming and skip some of those mistakes that first-time founders make.
Yeah, it's always better to have the money coming in. You miss all of those initial hurdles. And, if you're at the point where you have that type of money, you're probably doing all right career-wise. Like I've got some friends that are higher up in corporations where they're managing like teams of 50 or 60 people. Like jumping in and running a business isn't going to be that big of an issue.
Yep, that's exactly right. Because you're going to go from serious goals, quotas, budgets, problems, challenges to oh man, this I don't know, this web page isn't mobile responsive, so let's have a guy in there and do that. And you can kind of point and click, figuratively and literally, to get things done in the stage of small apps that you might buy through acquisition. There's a lot of leverage, and there are kind of those quote unquote quick wins. And I think it's actually worth mentioning the concept of quick wins. I'm not a huge fan of the Basecamp guys, David Hansen. I think they have a lot of toxic advice that convinces first-time founders to be lazy and to not really care because they're able to do that and win really big. But I think they made a really good point a while ago. They wrote a blog post on Medium about how the concept of quick wins they've deleted from their vocabulary because it's easy to hire someone or bring someone on board and say, yeah, there's a lot of, maybe you're hiring a marketer. There's a lot of quick wins. We could just do this, this, and this. And it kind of demeans this new hire because they say, well, if they're, quick wins, you should have just done them, as the maker, as the manager, as the founder. So I kind of agree with that. But I also think that when you acquire a company, you're an outsider looking in. And there are things that are obvious to you, how to improve the product, how to improve the marketing messaging, how to find new customers that aren't so obvious to the original founder, solely because you have that blissful ignorance as the outsider looking in.
Yeah, exactly.
Do you run a successful business that sells to other businesses but feel like you could be doing more? Well, at Experiment 27, that's exactly what we help other businesses do. Our focus is finding cornerstone clients, finding people in the Fortune 500 or finding brands that are over 15, 20, $30 million in revenue, a lot of times billion-dollar brands, and using our marketing tactics such as cold email or targeted content to find those customers and sell them on your business. If that sounds interesting to you and you want to learn how we met with, it's most of the Fortune 500 at this point, along with dozens of billion-dollar brands, companies like Krispy Kreme, Walmart, Morgan Stanley, and a ton of other ones, go over to experiment27.com. We'd love to chat.
Okay, so the biggest risk I can think of, so if somebody, let's say somebody is at like a Fortune 500 company in a managerial role, they've got extra cash, they want to buy a company. The biggest risk I can think of is they're buying the wrong deals, they're blowing all their money. So how are you sourcing these companies? How do you find out whether something's a good deal? And then how are you finding the companies as well?
So I think it goes back in one way. It's I guess it depends on everyone's interest, right? But on the other hand, I think it goes back to some basics in the investor private equity realm, which is having a thesis. And some people, thesis means a peer-reviewed paper, citations. But a thesis could also just be a few bullet points. I definitely suggest documenting it somehow, because else it doesn't really exist and you won't adhere to it. But we have a thesis that basically says we only work with Ruby Rails apps, right? We only work with like JavaScript, Vue, or Angular front ends, right? So we're not going to do React. We're not going to do, ASP.NET. We're not going to do certain technologies. And that may be a weird, characteristic. A lot of people are saying stuff like, well, I don't do social media, or I will or won't do pets or something like that. We're not so specific on that industry because I think that there are patterns in consumer behavior and how to figure out what people want and that kind of thing. But where there aren't patterns is being able to turn your world upside down and learn a new programming language overnight just because you got an app that's in that framework. And so we've made sort of some strict opinions about in our thesis of what we will and won't go for, and some really loose ones like the industry, for example. So I think when it comes to, the example you're talking about, which I think is actually probably millions of people, I think millions of people are working at good to great jobs and they have some extra cash and they're looking at things like Bitcoin and they're looking at things like, I don't know, crypto in general or Start Engine or accredited investor leniencies with the SEC. And should I invest in my friends and family round? Should I buy property? Especially people just getting into the early mid 30s range. I think if you've done okay, you have some cash and you're trying to figure out how do I turn it into more cash? And you don't know if you should start a company or buy Bitcoin. And I think that there are a lot of pitfalls you could fall in. But again, it starts with creating a thesis, which again could be a Google Doc or a note on your phone. What are you even interested in? Because if you don't have any interest, or if you can't achieve interest through learning, then that's mistake number one. Mistake number two is, I think, being now deeper and going bolder on those convictions. So, for example, we're interested in B2B SaaS, and we were open to different industries. But then the other day, we got an email from Instagram. I got an email from Instagram arbitrarily that said, hey, Instagram is going to change our APIs starting in June. This, and this are going to be cut off. This is going to change. And I thought instantly, okay, we're never going to do something that does social media scheduling. We're never going to compete with Buffer. We're never going to do anything that auto posts to Facebook or Twitter or Instagram or listens to things or records your likes or auto follows. We're not going to do any of that because we would be beholden to just a random newsletter that might come out from Instagram that says basically you're screwed. And so by just listening to the market, that's also helped form, our ideas about what we're interested in and what we're not.
You might have fallen into the same issues with FOMO, just buying into Shopify, but I see that you de-risked it, right? You built it for all these other platforms almost immediately.
That's exactly right. That was our biggest concern, actually, which was funny because what was really going for Notify, the app we bought, was that they were the first app to ever do this on the planet that I've seen as a service, and they were the only ones doing it on Shopify, or they were the first doing it, and then there were a few competitors by the time we acquired it. But even though Shopify was the source of its success, I also saw it as a big risk, which was, like you said, we have to de-risk this and be on other platforms. And so step one of that was, let's not reinvent the wheel. Let's not just go from Shopify to selling to SaaS companies, but let's go from Shopify to BigCommerce, to WooCommerce, to Magento. So the first thing we did when we were rebuilding the platform was we bolted it onto other e-com app stores. And then the next thing we did was we abstracted it further so that any website can.
So with Fork Equity, I see that you're raising money here. Would you recommend somebody, so I'm trying to figure out exactly how to phrase this. Would you recommend somebody invest with you, or would you recommend they source a couple deals themselves first, build up a little portfolio, and then work with somebody like Fork Equity? Or who's the customer for you ideally?
Sure. So actually the customer for us is pretty similar to this archetypal person we've been talking about today. So it's the person who's successful by every measure, and but not particularly or necessarily in technology. So we're working with someone who is really successful in brick and mortar. We're talking to some people who are really successful in e-commerce and who are really successful in physical textiles, right? We're talking to people who even who have MBAs and they work in finance and they don't know anything about technology. They know things about roads or infrastructure or manufacturing. But again, it's like you said, there's this characteristic where they've got some extra capital. They're trying to figure out efficient ways to deploy it that are both more lucrative and almost more importantly, more interesting and more engaging and enriching to their own experience than something like an index fund. And so our recommendation, I'm more than happy to help. I don't necessarily want to say coach or mentor. I don't necessarily pretend to know what I'm really doing here. We just got this going. But I'm more than happy to encourage someone who approaches us, let's say, and says, hey, we're interested in investing, but we also think we could do this on our own. I would say absolutely go do it on your own. Go do it on your own. Let me know how it goes. Here's 10 of our sourcing mechanisms. Here's a couple of things to keep in mind, right? Because I think ultimately what will happen is people will see the potential prospect for us. We'll see that maybe these guys have figured a couple things out that I haven't thought about, and it may be just as worth my capital to work with them instead. So yeah, I don't see it as super competitive, honestly. I think that VCs have to compete a lot more, because if you're selling, 10% of your business for 500 grand, everybody's 500 grand is the same. It's all the exact same. And all VCs try to pretend it's not, and they all have nice websites, and some of them have blogs and do events, but it's all the same. All money's green. There's very rarely the case that a venture capitalist adds any value. Maybe they hop on the phone and they connect you to an enterprise client, maybe. but pretty much it's all the same. So they have to compete. But I think when people buy your company and they say, hey, we're going to take it to this, and this level, that's greenfield, right? That's the same difference as hiring someone, and every candidate is very different. So when you're looking at who's going to buy your company versus who's going to invest in your company, it's a different diligence process, I think. And our ability to approach a company and say, hey, look, here's 6 acquisition announcements we've made. Here's some graphs on how we've grown companies. Our vision is to just double down on your own product roadmap and to expedite all the things you wanted to build anyway and to make it bigger. Well, now we're actually helping that founder fulfill their legacy and get paid at the same time. And I think that an individual investor, so one of our prospects who may be wondering, should I work with these guys with Fork or should I do it on my own? I think they'll see that. I think the sophisticated investor sees that, particularly if they're not already pretty well versed in tech.
Okay. And then if they were going to do it themselves, it seems like the process would be figure out what they have to spend, find a company somehow. You said you have 10 different strategies. Maybe is there a blog post or something where you talk about those?
Yeah, there should be. That's we're actually going to probably start open sourcing some of these processes as we figure them out. At first, it's literally just subscribing to information, right? So if you're not aware of what's going on in the markets, then you can't really make good choices. So it's totally fine, I think, recommended at least at first, to literally look at 1,000 companies to maybe pick one. At the very least, you'll learn peripherally what you like and don't like, and that actually can help you form your thesis, right? So what I like to do is find a company that I think is interesting, and then I try to find 5 of their competitors, and then I try to do my own analysis of what differentiates them. Who do I think is bigger or better? Who has raised venture money versus who is bootstrapped and has like maybe a chip on their shoulder? Maybe the one that's bootstrapped was founded by someone who left the competitor, right? So all these things get kind of interesting to look at, and you don't know any of that, and you're not cognizant of those probabilities unless you look at tons of companies. And I think it starts outbound. You go looking for things, and then hopefully over time, as you build a reputation, as you make announcements, as you sort of commit to the community that, hey, I'm a serious buyer, I make offers quickly, I can move fast, that kind of thing, then maybe there's an inflection point and there's a little bit of inbound as well.
Awesome. That's super helpful. And then, step 3 would be negotiate the deal. It sounds like your deals are mostly paying out over the month. Do you usually pay back more? You pay back more than the monthly revenue, right? It sounds like by only like 30 or 40% though.
To the investors?
Not to the investor, to the person you're buying the company from.
I guess yes and no. We've over the last few deals we've done, the payback periods were 6 months, 18 months, and 32 months. So pretty varied. But I also think that those were also kind of inversely correlated to how well we could accelerate it, right? So the company that was a 32-month payback period, I think that there are higher leverage nozzles that we can turn where we can actually accelerate that to 18 months. And the company that we got that was a competitor that we immediately shut down, that was a 6-month payback period. And we're never going to be paid back because we shut it down, right? So, and then there was one in the middle, 18 months, that maybe we can speed up by a factor of like 20%. So maybe we can pay it off in 10 or 12 or 14 months. So I think that's the case too, right? So the company that was a 32-month payback period, after a couple months of hacking on it and improving the design and all the things that I kind of think about when I think about, making over an app and kind of 2.0ing it, we immediately then doubled prices. So doubling prices for an app that already gets hundreds of signups a month is a really high leverage maneuver. Whereas if an app had 10 signups a month, even tripling prices wouldn't make a dent. We would potentially go from 10 signups to 0 signups. So in those cases, you have to do different things to get the same kind of growth and get the payback period down.
Awesome. And then the last one would be, so the big learning on that was, at least when I first heard it, was you don't need a lump sum to buy a business. Like you don't need to have the cash up front, which is what I thought it was the whole time.
Yeah. So that's probably the most, I think, encouraging and inspiring tidbit. And this isn't something I made up, but it's just the truth to how these deals go down. We look all the time at acquisition announcements from Google and big companies and small companies, so-and-so by so-and-so for 20 million or for an undisclosed amount. And sometimes they'll say, cash value, stock value. But no matter what they say, it still may be the case that there's a 24-month literal payback period where there's a seller side financing. And I've done deals like that too. And of course, that takes a lot of trust. I'm actually in the middle of a deal like that now on the seller side myself. So we're selling a company and it's going to be paid over several months' time to us. So I have to trust the buyer that they're not going to drop the ball, on one of their monthly payments. But it now enables this buyer to acquire an asset, and they'll own it outright on day one and then pay it off over time. And that's a really high leverage way to get these deals done. So if you're listening to this and you have even $20,000 and you're thinking, okay, what can I get for 20,000? You actually might want to think of it in terms of what can I get for 80,000, because I can pay 20K down and I can maybe pay $5,000 a month or a few grand a month over time. And even if you don't have $5,000 extra a month, maybe you have $1,500 extra a month, but the company you're going to buy for 80,000 makes 3,000 a month. Now combine your 1,500 with 3,000. As long as you're willing to work for free for 8 months, you now can afford an $80,000 business with 20. So again, that's really back of napkin, but that was one of the biggest things, eye openers to me too, from now being on both sides of that table, is the leverage that you get from upfront cash, deposits, seller side financing, being creative, but also being honest and genuine and how you get the deal done. You can do a lot with less.
And then the last one was reinvest all the profits in a team for as long as possible.
Yes. So when I go on sites like Flippa and side projectors and just different sites where people showcase side projects, and someone might serendipitously say, hey, let's, can I buy it? Or can I work with you? Or, this happens on Reddit, these kinds of places. What I find is people buying the apps, and I know we talked about this being your perspective on simple apps and potentially being my perspective on some deals too. When you buy an app and just sit on it, you may actually be harming yourself in the long term. You can wait 12 months and you can afford that and break even. But that's assuming that your app and the market for your app exists in a vacuum. What if your app is about to have its lunch eaten by a brand new competitor who sees your app and you haven't touched it? So now you're actually creating more risk for yourself by not reinvesting into the app, by sitting on it. And so I think that's a decent example with simple apps, right? So like the unit pricing app that Alex bought for people listening for me, it's the only app that does what it does. But I know how developers are trolling the Shopify app listings, trolling the forums, looking for use cases, right? Hanging out in Thailand and trying to pay their $300 a month rent. I know how it goes. And they're going to look at that. And if you don't do too much with it over the next couple months, then they might try to compete with you. And you sitting on it saying, well, I'm just going to make my money back and profit from it later, may actually be riskier than spending, a few hours a month with a developer and blowing the $200 or $300 or $400 revenue a month on that developer to get it to a more formidable place, so that then in a few months you can begin that hold sitting on it and getting your ROI period.
Exactly, which didn't matter too much for me, because even if I lost all 2,500, it wouldn't have. It's not that much money, but if it was like 500,000 or something, it would have been, devastating.
Yeah, exactly. So,
all right, Ryan. Oh, actually, go ahead if you had something else.
Yeah, well, I was just going to mention that kind of fundamental to what we're talking about here is we're not talking about buying big companies, right? Simple apps, $2,500. Some of these apps, $30,000, $100,000, $500,000. None of these are very big companies, which means there's a lot of inherent risk in whether or not they'll exist in the future. And so I think a big part of that post-acquisition process, the hold period process, is fortifying the app, whether it's product, pricing, customer service, reviews, whatever it is that it's missing, and making it more formidable. And that's almost the best way to de-risk your investment in the short term versus just sitting on it. And so what we're doing at Fork is kind of that. We're able to communicate to potential investors that the moment we own it, within maybe even hours, the app, the product, the customers will be happier, the product will be better. And that's a big plus to them if they're coming in with the mentality of, I'll just hope no one competes with me until my payback period is over.
Perfect. Where can people check you out online, Ryan?
They can check me out on my website, which is ryanculp.com, or Ryan C. Kulp on Twitter. I do not have Facebook. I do not have LinkedIn. I do not have Skype. I do not have Instagram. I don't do these things, but they can check me out there, and that will kind of link to other things that I'm up to.
Perfect.
Yeah,
thanks for being
Alex,
here.
I appreciate it.
Have you been trying a bunch of different marketing tactics and nothing's working? I would love to work with you one-on-one to figure out exactly what's wrong. Whether you're using cold email to get billion-dollar clients on board, like I've done for most of the Fortune 500 for our clients, or you're using YouTube videos. We have over 23,000 subs, so I know something about that. Or sales strategy. Sold millions and millions of dollars in business-to-business transactions. If you're dealing with issues in any of those, I would love to have a one-on-one consulting call with you. You can get more info on that at experiment27.com/consulting. You can also check out my social media. I'm on Twitter, Alex Berman with no E, ALX Berman. or Instagram AlexBerman1. Till the next episode, I will see you later.